Hey, this is Nick from Income Digs, and today we're going to talk about how you can avoid a $50,000 mistake as a bookkeeper or an investor hiring a bookkeeper. We're going to talk about bookkeeping for real estate investing. It's going to be short and sweet, but I want to make sure we're doing one thing really specifically right. Now, if you like this video, you're going to really like all the content we have available at incomedigs.com, including our end-to-end course, Real Estate Accounting Bootcamp. Definitely check it out, whether you're an investor or a bookkeeper looking to cash in on this lucrative niche. Let's get into today's topic, which is how to avoid a $50,000 mistake. And it comes down to one key concept that I see over and over again, and I need to harp on it really, really seriously. So first of all, QuickBooks is the best bookkeeping software for investors, okay? Everything that I say about, it might not do this right or might not do that right, it is, at this point in time, the best software out there for an investor. However, it wasn't built for investors, and we need to understand that, and we need to embrace it and understand that we need to do a little bit more to make it work for us and for our clients who are investors. Specifically, investors need to track financials in multiple dimensions, and the really specific one is property, okay? Whereas other businesses can track their profitability and their balance sheets, and it's kind of a general type thing. Investors very specifically need to know how much each property makes and how much each property is worth. And that problem presents other problems for QuickBooks. And if we don't pay attention to it, and we kind of get lazy with our setup, we can really make some big errors that cost us or our clients tons of money, $50K plus. If we assume $1,000 a week bookkeeping bill, okay, that's what we're talking about. If we can save $1,000 a month by not having useless books, all right? So here's where most of us get it wrong. It all centers around the chart of accounts. Now, your chart of accounts, you've heard me say it before, it's the architecture of your books. It's the backbone of your books. It needs to be built the right way. And here's where a lot of us get it wrong. One, we add too many accounts too quickly. How many of you as bookkeepers have had a client who gets excited about their new QuickBooks account? They set up their bank transactions. They have everything coming in. And they just start willy-nilly adding transactions, adding categories, and adding this giant list of accounts without thinking about it ahead of time. We get too excited. We get trigger happy. Too many accounts. We also get caught up in thinking that there's one right way. Okay, I can't tell you how many times I've heard somebody say, well, my CPA says I have to do it this way, or the IRS says I have to do it this way. Remember that QuickBooks is software that you choose to use, all right? There's nothing that says from the IRS or from your CPA that says you need to use QuickBooks or any other accounting software. So how can they tell us how we have to use it, right? Okay, QuickBooks is just a tool to help us get the answers, right? If we're just using Excel, which many people do, or maybe just a shoebox full of receipts, there's no rules about that, right? But it's only when we use QuickBooks that we start hearing, oh, this is the only way to do it. So whether it's your CPA, the IRS, or even if it's me, you see the way that I set up my chart of accounts, understand and have confidence in the fact that you or your client's business is unique, is different, and there might be a reason to alter your chart of accounts. Lastly, we have bookkeepers or investors who are specifying different accounts for each specific property. This is the big one. This is what makes our balance sheet or our P&L unusable. And when I talk about a $50K mistake, I'm talking about spending a year setting up QuickBooks only to find you have unusable reports. We completely wasted the year. We now have to go out and spend more money to fix it. And hopefully this time we get it right. Unusable reports means wasted bookkeeping dollars, okay? And whether you're a bookkeeper yourself, you're going to lose that client for sure. If you're the investor, you're going to be wasting a ton of money. All right, let's get into QuickBooks. Let me show you what I'm talking about and show you what the fix is, okay? This is the most common thing we see. I'm showing a chart of accounts now. Now we have fixed assets for our properties, and we list the property and some sub-accounts for each property with the address in it. Okay, this should be a red flag. Seeing addresses in accounts is a red flag. We do not want to see this. This is what I call a one-dimensional chart of accounts. What I'm going to demonstrate for you is I'm going to create a transaction in the one-dimensional way and the two-dimensional way. We're going to show why we absolutely need to be thinking about things in multiple dimensions. So here is kind of one way to set it up. This is not the right way in my opinion. I'm going to go to an empty balance sheet way back in time just to demonstrate this point. So I'm going to go and create a journal entry for the purchase of property way back in 2017. I'm going to do it kind of the wrong way, okay? You saw all those accounts with those addresses. Let me go ahead and do exactly that. Let me pull those in. 122 Buffalo Street land, that's one of my properties. Then I got buildings. Then I got closing costs. Hey, I'm doing some things right. I'm adding to my basis properly, right? Let's say my land's worth 25K. My building's worth 50K. Closing costs, or let's say the building's worth 125. Closing costs 5,500. Let's say that I got really lucky and I got a beautiful conventional mortgage for exactly that amount. All right, and we can actually, sometimes we see this too, 122 Buffalo Street. There it is, yep. All right, so we do it like that, and then we can even put in another property. Let's do that 264 Union one, that's my land. Here is my building, and here is my closing costs. All right, let's say that this one's worth a little bit more. Closing cost 7,500. Let's do one more. Let's like really drive this point home. I think I have this maple in here. So we'll go maple, land, and sorry, I did not do the mortgage yet for 264 Union. Let's do that one. Okay, right there. Let's do 456 maple. All right, so I'm gonna put 3 properties on my balance sheet. Just kind of arbitrarily pricing them here. So I have my closing costs at 10.5, and then I have a mortgage on that one too. I think I have a mortgage account in there. Boom, right there. All right, so I'm gonna save and close this, and what should happen is my balance sheet should be populated now with these 3 properties. And you see that's exactly what happens. I got 122 Buffalo, 264 Union, 456 Maple, the sub accounts as well, the mortgages as well. Nice and simple. There's my balance sheet. This looks fine on the surface. However, a few things we have to keep in mind. One is that I have one single transaction, 3 properties, and I've got 12 lines on my balance sheet. All right, now I haven't yet added any bank accounts, credit card accounts, escrow accounts, accounts payable, accounts receivable doesn't show up here, security deposits, equity, nothing else shows up here. And the other thing is I only have 3 properties. What if I had 10? Think about how gigantic our balance sheet is going to look. It's going to become unusable. So we need to think of a better way to get these 12 lines for 3 properties down to something a little bit more manageable, potentially 4, okay? And that's where the 2-dimensional chart of accounts comes in. We're gonna accomplish this in 2 tasks here. The first is we wanna make a generic account for our assets. We're going to do this on the balance sheet as well as the income statement. So instead of addresses in them, we want them to be more generic. Land, building, closing costs, right? However, we still need to differentiate our properties. So we need some other attribute, and we're going to use either class or customer. In this case, I'm going to use class. So I'm going to go to advanced, which is only something that's available on QuickBooks Online Plus or beyond. I'm going to turn on class, okay? If you don't have QuickBooks Online Plus, first of all, I encourage you to get it. If you have more than one property, it's probably worth your while, worth your money. If not, you can use customer in the earlier or the less expensive versions, okay? So I've taken those 2 steps, I've turned on class, and all class is, if I go to my lists here, it's just a listing of kind of categories, right? And I've decided to have my properties be the class. So there they are. So let's go to that report as of 2017. Okay, this exact transaction, I'm gonna drill down into it, and now I'm gonna make the adjustment from a single or single dimension chart of accounts to a 2-dimensional chart of accounts. Let's drill down into this one, and notice that the class field now shows up. So what I'm going to do is I'm going to change these accounts from being specific to generic. So instead of 122 Buffalo Street land, I'm just going to do land generally. Same thing for buildings. I'm going to do it from 122 Buffalo Street buildings to a generic building. Okay. Closing costs, I can do the exact same thing. And then mortgage, I can do that as well. So I can just do a conventional mortgage. Now the mortgage one, I will say, is something that we would sometimes keep specific if we're matching the bank feed, but you can also keep it generic. I like to do it that way. Now that I've made these generic, I'm gonna pick up my class is going to be where I differentiate the property. So this is my 122 Buffalo. All right, so the same information, but I'm just separating it out into different fields, which is going to really open up my potential for reporting. Okay, so here's land, building, closing costs, and there's my conventional loan. Okay, this I'm going to indicate 264. So I'm almost done. I got one more to do. And again, we're getting the same exact information, but I'm going to be taking advantage now of a 2-dimensional chart of accounts. I'm going to have less lines on my balance sheet. All right, so I'm doing the last one here is for 456 Maple. There we go. Okay. All set. Let's save and close. See how this impacts my balance sheet. So go back to my report here. Just refresh this. So what we should see now is we should see an elimination of the address from the account. And then we do see that, right? And now we have a total of all those values here. All right, so you can see that we've gone from 12 lines to 4. Now, the other thing we need now is the property information. This is where we're going to turn on that second dimension. Here's my balance sheet. I can now display columns by classes is how I differentiate it. Go ahead and run that report. And there I have a really nice, neat table that shows me by property what the value is. Okay, so now we're growing in 2 directions instead of just 1. Remember, thinking about scalability and if I had 10 properties, how long my balance sheet would get. Now we think about, okay, we can keep our chart of accounts consistent and our balance sheet's going to grow laterally, sure, but now we can start doing some grouping and things to make our report readable. Now, this doesn't just apply to the balance sheet, it surely applies to our P&L as well. As I show you that example, we should absolutely have a profit and loss by class or by customer, properties across the top, and then your very generic no address in your P&L as well. Okay, this is crucial. Right? So if you're a bookkeeper and you're doing a single, address specific chart of accounts, you're really doing a disservice to your client, your investor. And I guarantee they're going to get to a point where they're like, hey, this doesn't work for me. This is unusable. And you're probably going to lose that job and they might even ask for some money back. I probably would, right? So if you're an investor, you want to make sure that whoever you are hiring is thinking in this way, right? Is this scalable for me and my business? This is crucial. And this is probably the top thing that I see when people come to me and say, hey, I need to do bookkeeping for real estate investing. This is typically the first thing we tackle, is converting from a single dimensional chart of accounts to a two-dimensional chart of accounts, right? So if you thought this was useful, I hope you did. Hopefully we can stop what we're doing the old way and get into the new way of doing it. Definitely check out the course that I have as well, Real Estate Accounting Bootcamp. We get into this and so much more to make sure that our setup is super strong so that we as bookkeepers can get more clients in this awesome niche. And if we're an investor, we want to be able to be doing more deals and spending less time in the reconciliation. So definitely check out that as well, Real Estate Accounting Bootcamp, and I will see you on the next video.